Should you invest your money today or wait for the market to fall first? It sounds like an easy decision. After all, buying something on sale is almost always better. But what if waiting for the perfect opportunity actually leaves you with less money years from now? Today, we're going to compare two of the most popular investing strategies using simple examples, real historical evidence, and investor psychology. Because the answer isn't nearly as obvious as social media makes it seem. And as always, this video is for educational purposes only, not financial advice. Let's start with a simple example. Imagine you're shopping for groceries every Saturday. Some weeks, apples cost $2 per pound. Other weeks, they're $3. Occasionally, they're only $1.50. You don't know next week's price ahead of time, so what do? One option is to buy apples every Saturday. The other is to wait until they're on sale. Investing works surprisingly similarly, except there's one important difference. Nobody knows when the sale will happen. Dollar cost averaging, often shortened to DCA, is simply investing the same amount of money at regular intervals. Maybe it's $200 every month, maybe it's $500 every paycheck. Sometimes you'll buy when prices are high, sometimes you'll buy when prices are low. Over time, your average purchase price naturally smooths out. Instead of trying to predict the market, you're building consistency. Buying the dip means waiting until prices fall before investing. The idea sounds logical. If you buy cheaper, shouldn't you make more money potentially? But that raises a much harder question. What exactly counts as a dip? Is it 5%, 10%, 20%? And perhaps the biggest question of all, how do you know prices won't keep falling after you buy? Those are much tougher questions than they first appear. Let's compare two fictional investors. Steady Sarah invests $500 on the first day of every month. She never checks headlines before investing. She simply sticks to her schedule. Then there's Waiting Will. He also saves $500 each month. But instead of investing immediately, he waits for what he believes is a meaningful market drop. Both have the same income, both save the same amount, both plan to invest for 20 years. The only difference is their strategy. Imagine the market rises steadily for 8 months. Sarah buys every month. Will keeps waiting. Finally, the market falls 10%. Will celebrates. He invests all the money he's been saving. Sounds like he wins. But here's the catch. Even after the decline, prices may still be higher than when Sarah made several of her earlier investments. Waiting only works if you correctly predict both when to get out and when to get back in. That's much harder than it sounds. A simple numbers example. Suppose the market starts at 100. Over several months it climbs to 130. Then it falls 10%. Now it's at 117. Someone waiting for the dip finally buys. But someone investing consistently already purchased shares at 100, 102, 105, 108, 110, long before the market reached 117. The discount wasn't actually cheaper than many earlier opportunities. That's why context matters. A decline doesn't automatically mean a bargain. The biggest myth. One of the most common investing myths is this: waiting is safer. Not necessarily. Waiting avoids short-term losses only if prices actually fall, but while you're waiting, markets can continue rising. Historically, stock markets have spent far more time making new highs than making new lows. That means waiting has an opportunity cost. Every month your money stays on the sidelines is another month it isn't participating in long-term growth. But doesn't buying the dip sometimes work? Absolutely. Sometimes markets experience major declines. Investors who have available cash during those periods can benefit from lower prices. There's nothing inherently wrong with buying during market downturns. The problem is expecting to consistently predict when those downturns will happen. Even professional investors struggle to do that over long periods. That's why many financial professionals focus less on perfect timing and more on maintaining a disciplined investment process. The psychology behind it. This is where investing becomes less about mathematics and more about human behavior. Imagine you've been waiting 6 months for a market correction. The market finally drops. Instead of investing, you hesitate. What if it falls another 15%? So you wait. Then another headline appears. Then another. Before you know it, the market begins recovering. Now you're afraid you've missed your chance. Fear turns into hesitation. Hesitation turns into inaction. This cycle repeats itself more often than many people realize. Ironically, the biggest obstacle isn't the market, It's our own emotions. So, which strategy wins? For many long term investors, dollar cost averaging offers several advantages. It removes much of the emotional decision making. It creates a consistent saving habit. It reduces the pressure to perfectly predict market movements. But that doesn't automatically mean buying the dip is a bad strategy. If you already invest consistently and happen to have extra cash available during major downturns, adding additional investments can also make sense. The key is that the extra purchases complement your plan rather than replacing it. The real question. Instead of asking, which strategy makes the most money? A better question might be, which strategy am I most likely to follow for the next 20 years? Because the perfect investment strategy only works if you actually stick with it. Consistency often beats perfection. The debate isn't really about dollar cost averaging versus buying the dip. It's about building a strategy that matches your goals, your timeline, and your comfort with risk. History suggests that staying invested has generally rewarded patient investors over long periods. But every person's financial situation is different. That's why understanding your own behavior may be just as important as understanding the market itself. If you found this video helpful, consider subscribing for more evidence-based investing content that breaks down complex topics into simple ideas. And let me know in the comments, are you team dollar cost averaging, team buy the dip, or do you combine both? Thanks for watching, and I'll see you in the next video.